All right, welcome. Hello, everyone. Thank you for joining me on this month's Capital Classroom educational presentation. Now, before we dive in, I thought that we could warm up a little bit with a little tax brain teaser about Bill. Does that sound good? Well, after working hard for his entire adult life, Bill, age 65, has finally retired and he's going to more concerts than ever before. Bill has $46,138 in taxable income, which includes $37,500 of Social Security benefits this year. And as you can see, Bill's $46,138 of taxable income puts him in the 22% tax bracket because it's more than $44,726 and less than $95,375. Toward the end of the year, Bill decides to take an extra $1,000 out of his IRA for a trip to see Willie Nelson play in Austin, Texas. Question is, how much is he taxed on that extra $1,000? The logical answer is that for every dollar of IRA money that he pulls out, he pays 22 cents in federal income taxes. Therefore, if he took out $1,000, he should owe $220 in federal income tax, 22% tax. Simple enough, right? Unfortunately, he owes $407 in tax, a 40.7% federal tax rate on that income. And that is thanks to the madness that is our tax code and the unique formula that determines how your Social Security benefits are taxed. The real answer is that Bill owes $407 on that extra income. So welcome to our presentation, How Tax Planning Changes Through 4 Stages of Retirement. If we've not met before, my name is Eric Hagan. I'm a financial advisor and president of the independent wealth management firm Capital Consulting Group in the Twin Cities area. I thank you for being here today, for learning more about taxes in retirement. And I want to assure you of one thing about this presentation. I believe you'll be better informed about the challenges of retirement tax planning after listening to this talk. Now, you may be wondering, why is a financial professional giving a presentation about retirement tax planning? Well, from time to time, I present different topics, such as areas of Social Security, retirement planning, IRA planning, healthcare planning, cybersecurity, late stage college planning, among others. And my goal is always to inform and educate my audience so that you can understand how critical financial planning topics affect you and your family. And I do this presentation because I've seen many people make mistakes and pay more taxes in retirement than are necessary. When that happens, it makes my job harder because people have less income in retirement and we have to find ways to make their portfolios last. Taxes can seem complex and jargon filled, even though the underlying concepts are fairly straightforward. So, let me take a second to explain how this presentation, how this message is going to unfold. The presentation is organized into 4 keys. Each of the 4 keys builds on the previous one to form a solution to our presentation problem, as you'll see. To help you remember what we're covering here today, I do have a summary that I can get to you after today's message. It's titled How Tax Planning Changes Through 4 Stages of Retirement, same as our presentation here today. So I can get you a copy of this after today's message. So feel free to take notes, but I do have a nice summary that I can get to you as well. Now, you may have questions as we go along, and I want to be respectful of everybody's time. So I'm not going to take any questions during the presentation. I just want to make sure that I get everybody out of here on time. But I will tell you how you can get all of your questions answered when we wrap up today's message. So write your questions down as we go, and you will have an opportunity to get answers to those questions. And then I want to mention that at the end of our presentation, I'm also going to invite you to a one-on-one conversation with me. It's a complimentary conversation meeting. We can do it in my office here in Eden Prairie. We can meet one-on-one via Zoom. We are set up to be 100% virtual. So stick around till the end so you can learn more about how to get that as well. And I also want to assure you that this is not a sales presentation. You will hear nothing remotely close to a sales pitch here today. All right, so there is one other last important point that I need to make, and that is everyone's tax situation is different. You should always consult a qualified professional tax advisor to discuss your specific tax situation, especially as we talk about some of these different topics, like traditional IRAs. High level, you know that you must pay taxes on the distributions or conversions at ordinary federal and state rates. Money grows tax free and earnings may be withdrawn taxable, right? You also have Roth IRAs. You don't get a tax deduction when you put money into them, but money grows tax free and the earnings can be withdrawn tax free if you follow the IRS rules and then also state taxes, right? So, talking to different people in different states. And so, we're primarily going to focus on federal taxes, but you just keep in mind you may still face state taxes as well. So, you need to check with your tax professional. I am a financial advisor, I do not provide tax advice. What I do is help people understand how the tax code and other rules could impact their financial planning and their investments. And then we develop a plan to take into account many of the odd things people encounter, especially around taxes in retirement. Our goal here is to help you understand that the retirement distribution game, which is spending assets in retirement, is much different than the accumulation game when you are saving for retirement. Chances are you have been in the accumulation phase of your life for several decades and you've been working hard and trying to save money, and hopefully your accounts have grown. But now, as you enter or prepare for retirement, you're in an entirely different phase, the distribution phase. And the distribution phase has new, strange rules that can catch people off guard. And along with those new rules, there are often many changes in your own personal life that can have a big impact on your taxes too. For instance, your children, maybe they're grown. That means no more child tax credits. Your house may be fully paid off, and that means no more mortgage interest deduction. If you've already retired, you may no longer be receiving tax-free employer-paid medical insurance. If you've stopped working, you may no longer have the ability to stash income in a 401k or a similar plan to manage your annual tax bill. At some point, if you haven't already, you'll start taking Social Security. And sooner or later, when you reach 72, and that's a moving target now as well, you'll have to start taking required distributions from your retirement accounts. The list of changes goes on. Many aspects of retirement will affect your tax bill in ways totally different from your working years. Understanding what these are and how they can impact you is absolutely crucial. Now, at this point, you may be thinking, okay, so what's that first key? What is the first thing I need to understand about retirement and taxes? So, our first key is you have to know what your after tax retirement savings picture looks like before you actually retire. Because a $500,000 401k or IRA balance isn't really $500,000. The government has a claim on part of that money because the taxes were deferred. They'll get their share when you're forced to start taking your required minimum distributions. The RMD age was 72 last year, but the recent Secure Act 2.0 has pushed back RMDs to 73 if you were born between 1951 and 1959. If you were born after that, you won't have to start taking RMDs until you turn 75. Now, obviously, the higher your tax rate in your retirement, the less your account is actually worth. Here's an example. This chart shows you the cumulative after-tax amounts you could expect to receive from a $500,000 IRA earning 6% per year at various tax rates. As you can see, the lower your tax rate, the more you keep. Simple in theory, difficult in practice. And by the way, of course, This presentation applies to both pre-retirees and retirees. So don't worry if you've already started your retirement. Tax planning is important throughout your retirement. Now, you may be thinking, okay, my accounts may not be worth as much as I thought, but I'll have a steady flow of benefits from Social Security to supplement my income, and I'll have Medicare to pay my health costs. But one thing you need to understand when creating your retirement tax strategy is Social Security and Medicare have their own tax traps that you need to plan for as well. So that's key number two. So the next thing we're going to look at is Social Security and taxes. So let's go back to Bill from our tax brain tease. We want to understand why he paid such a high tax rate on the extra money he took from an IRA to go on that concert road trip. Remember, Bill has $38,000 of IRA income, part of his adjusted gross income of $61,838. And he has $37,500 of Social Security benefits. That puts him squarely in the 22% tax bracket, and he takes the standard deduction. Yet, when he took that extra $1,000 IRA distribution, he got hit with a nearly 41% marginal tax rate, $407 on that $1,000 distribution. So let's break down how this actually happens. First, let's remember the only difference between our two scenarios here is that Bill has taken an additional $1,000 from an IRA. You can see that in the after concert trip column. He has $39,000 in IRA income. So we see here that by adding that additional $1,000 of actual income, it increased both his AGI and his taxable income by $1,850. That means for every dollar of income he actually received, he's being taxed on $1.85. How does that work? Well, here's the deal. Depending upon how much other income you have, the amount of your Social Security benefits that are taxable varies. For instance, if your other income is low enough, all of your Social Security benefits will be income tax free at the federal level. On the other hand, if your income is high enough, up to 85% of your Social Security benefits can be taxable at whatever your personal rate is. Bill finds himself in the latter scenario. At his current income after the concert trip, for every dollar that he takes out of his IRA, he not only adds $1 of IRA money to his taxable income, but he must also add an additional 85 cents of taxable Social Security benefits. And if you add that up, that's $1.85 taxable at his 22% rate for every $1 of additional IRA income he actually receives. If you do the math on that, it comes out to a 40.7% real tax rate on the additional $1,000 of income. That is the so-called Social Security tax torpedo, and it can impact single filers and married couples with even fairly modest income during any stage of retirement. It's one reason planning taxes in retirement is so important. All right, so next let's look at Medicare and taxes. More specifically, let's look at how something that Medicare calls IRMAA, IRMAA, can impact some couples in the go-go years, as we like to call it, and beyond. So first, what is IRMAA? IRMAA stands for Income Related Monthly Adjustment Amount. The emphasis is on income because it is a monthly tiered surcharge, again, a kind of tax, that is tacked on to people's Medicare Parts B and D premiums. But it only happens if you have income over $97,000 for singles and $194,000 for married couples. Let's take a look at what this means in action. Meet George and Martha. They are a high earning married couple, and both are Medicare Part B and Part D participants. IRMAA surcharges affect income from 2 years prior, and this couple was on track for $306,000 of modified adjusted gross income in 2021. But on December 1st, 2021, George decided to sell a stock he bought for $10,000 on July 1st, 2007, and he sold the stock for $11,000. The resulting $1,000 of gain was taxed at the 15% long-term capital gains rate plus an additional 3.8% net investment income surtax for a total federal tax bill of 18.8%. That 3.8% net investment income surtax is another tax that comes into play when your modified adjusted gross income exceeds $200,000 for singles and $250,000 for married couples. So, George and Martha owe $188 of tax on the gain from the sale of the stock, right? 18.8% of $1,000? Or do they? Remember, my definition of a tax is any cost that increases as your income increases. So then, Georgia and Martha will owe more than the $188 because the gain from the sale of stock pushed them off the Medicare IRMA cliff into paying higher Medicare premiums. So let's take a look at that. Look at this Part B IRMA chart. That extra $1,000 gain pushed their adjusted gross income into the next premium tier that starts with $306,001. So now, instead of owing $329.70 each for their monthly Medicare Part B premiums, George and Martha will owe $428.60 per month, an extra $98.90 per month. Multiply that by 2, and it's $197.80 per month for an annual total in additional income-related monthly adjusted Medicare Part B premiums of $2,373.60. But it's not over, because Medicare Part D IRMA charges are also impacted. George and Martha will each owe about another $19 per month for their drug plans, an extra $460 for the couple over the course of a year. Adding all the IRMA surcharges together for the year, George and Martha will each owe about an extra $118 a month, or about $2,834.40 for the entire year. Now, combine that amount with the $188 of actual federal income tax they would owe on their stock sale, and the total tax owed on the $1,000 of gain comes to $3,022.40. That is a tax rate of 302%. Let me repeat that. That is a tax rate of 302%. Let's do a quick review. They sold stock for $1,000 for $1,000 income gain. The stock sale tax was $188. 15% for long-term capital gains and 3.8% for the net investment income tax for high earners for an 18.8% tax rate. The extra income from the stock sale triggers new IRMA tiers. The total IRMA surcharges amounts for the year to $2,834.40 for George and Martha. So the extra $1,000 of income triggers taxes of $3,022.40, or a 302% real tax rate. You see, being pushed into a higher Medicare Part B and D premium range is worse than being pushed into a higher tax bracket. That's because if you go over a regular tax bracket by even a single dollar, only those last dollars are taxed at the highest rate. But if you go over the Medicare Part B and D income levels by even a single dollar, you move into the next premium tier. It doesn't matter if you exceed the limit by $1 or $10,000. That's what they call the IRMA cliff. Now keep in mind, your IRMA payments are not determined by how much money you made the previous year, but rather your modified adjusted gross income from 2 years ago. It's another tax thing that catches people by surprise and needs planning. Making sure that you enroll in Medicare at the right time is a critical decision. If you bungle it, you'll get hit by a lifelong penalty. To help you understand, meet Jim and Ann. Both of them are 68 years old. Jim retired at 65 and Ann retired at 66. Prior to her retirement, the couple had health insurance through Ann's employer, and they continued that after Ann retired because her employer offers retiree health benefits. Unfortunately, they didn't know that they had to enroll in Medicare Part B as soon as Ann retired. Now, even though Ann's employer offers retiree health insurance benefits, those benefits are generally paid secondary to Medicare after retirement. But Jim and Ann did not realize the mistake until it was too late. And thanks to the way Medicare enrollment periods work, they were not able to begin coverage until the next year. In a worst case scenario, this might have resulted in a gap in coverage for Jim and Ann if they had had a major medical need. But even in a best case scenario, because Jim and Ann missed their deadline to sign up for Medicare Part B, they will each owe a 10% Medicare Part B base premium penalty for life. You can see how much that translates to in real dollars. They owe $395 extra in 2023, and historically, we can estimate that premiums will be higher, so that 10% penalty will grow and grow. Over the course of a lifetime, that could translate into a $10,000 mistake for the couple. For simplicity's sake, we're assuming that Ann's retiree health insurance covers prescription drugs, so they don't have to sign up for Part D. Just know there's a penalty for that too. We've seen how much or how Social Security and Medicare have their own tax traps and unique rules and penalties. So if you're like some who have seen this presentation, you may be asking yourself, wow, are there other tax traps that we're going to face in retirement? Well, the rest of what we're going to cover is not like what we've seen with the Social Security tax torpedo or the Medicare Irma cliff. The public generally is not aware of those tax squeezes. What we're going to see now is how the tax code in plain view snags retirees, especially when there's no planning. And that brings us to our third key. You must plan how and when you will use taxable, tax deferred, and tax free assets to manage your income and tax brackets efficiently. You cannot be haphazard about tapping your tax deferred savings. Timing is everything. And if you don't plan carefully through all stages of retirement, you'll encounter unintended tax consequences. So let's take a look by first addressing a question I hear often when doing retirement planning. Which accounts should I spend first? One way to help manage your income both before and during retirement is to utilize Roth IRA conversions. A Roth IRA conversion is a simple process that allows you to move money from an IRA or other pre-tax retirement account like a 401k to a Roth IRA. In general, the amount that you convert is added to your income for the year and will be taxed at your rate. For example, if Jill converts $100,000 from her IRA to a Roth IRA, she will have to add $100,000 to her income. The conversion income will be taxed at Jill's rate. For that reason, it's recommended that prior to making any conversion, you consult with your trusted tax professional. A conversion does not need to be all or nothing, though. One helpful conversion approach is called filling up the bucket. A conversion does not need to be all or nothing. Again, you may find yourself in the middle of one of the tax brackets with room to add more income without pushing yourself into a higher bracket. For example, in 2023, the 22% tax bracket for married couples filing a joint return goes from about $89,451 to about $190,750. If you file a joint return and your taxable income is $100,000, that means you could add another $90,000 of income without going into the next tax bracket. Making a Roth IRA conversion like that could make sense. If you plan to convert a large IRA, this approach is often more tax efficient than converting the full amount in 1 year. Instead, you can make smaller Roth IRA conversions over a number of years, filling up your bracket each time. This can help reduce the average tax rate you'll pay on your converted money and also help spread the tax bill out over a longer period. Some tactics you could use in managing income around tax brackets might include withdrawing tax free money from life insurance policies to keep your income low, selling highly appreciated stock for low or no capital gains, taking distributions from IRAs or 401ks to take advantage of a lower tax rate. And as we've seen, you can also consider partial Roth conversions to fill up lower tax brackets. There are also two other retirement strategies to consider, but they don't apply to all people. The first has to do with how you use your health savings account. This would only apply to people who are covered by a high deductible health plan. The second has to do with small business owners. Those who want to be extra tax savvy in saving for retirement can fund a company pension plan, which for certain high earning business owners can increase their ability to claim the qualified business income or QBI deduction. Both of these features of the tax code could be used to manage your tax exposure and provide significant tax favored benefits throughout retirement. If if either or both of these apply to you, go ahead and note that now on the on your notepad, and so we can review it later. We've seen throughout our presentation so far the critical importance of managing our tax deferred accounts because at some point you will be forced to take out required minimum distributions or RMDs, and that can be troublesome for your tax bill. But many people make charitable donations supporting their favorite nonprofit with annual gifts. So let's look at how your RMDs and charitable giving may work for you with a little bit of planning. Meet Albert and Shirley, who are in the 24% tax bracket. Now, the standard deduction for a married couple filing a joint return in 2023 is $27,700. But Albert and Shirley are over 65 years old, so they each get an additional standard deduction, bringing their total standard deduction for 2023 to roughly $30,700. This means they will receive no tax benefit for any itemized deduction unless their total exceeds that $30,700 mark. So, if Albert and Shirley have $15,000 of existing itemized deductions, say from state and local taxes, deductible medical expenses, maybe mortgage interest, what happens tax wise if they donate $5,000 to charity? They get no federal income tax benefit from making the charitable contribution because it does not exceed their $30,700 standard deduction. Now, that's not to say they shouldn't do it, but they should understand it's not helping them save on taxes. Now, if you're over 70 and a half and have an IRA or an inherited IRA, there is another way to give to charity than simply writing a check. It's called a qualified charitable distribution, or QCD for short. Let me explain how this works so you can see why a QCD can be so powerful. First, some rules. If you are 70 and a half or older, you can make a qualified charitable contribution of up to $100,000 each year from your IRA. If you're married and both of you are 70 and a half or older and both of you have an IRA, you can each make up to a $100,000 qualified charitable contribution from your own IRA. Second, any qualified charitable distributions you make counts towards satisfying your required minimum distribution for the year. However, when you make the distribution from your IRA, it must go directly from your IRA to a qualified charity, or you can receive a check from your IRA custodian made payable to the charity. Third, and this is an odd part, even though you gave to charity, you get no income tax deduction. So, Why would I suggest a strategy where you get no deduction for giving to charity? Because when you make a qualified charitable distribution, the distribution from the IRA is never counted as income when you compute your taxes. So let's see how that helps Albert and Shirley. First, let's suppose Albert and Shirley do what many retirees would do. Albert takes his required minimum distribution of $5,000 at the beginning of the year and deposits into the bank. He is done with his RMD for the year. Now, being charitable people, they donate $5,000 to charity. The end result is that the charity gets $5,000. Follow that, right? But let's look more closely. By virtue of giving to charity this way, Albert and Shirley's $5,000 charitable contribution will cost them a total of $6,200. Why? Because the $5,000 RMD that went into Albert's checking account at the beginning of the year still has a tax cost. Remember, the couple is in the 24% tax bracket, and 24% times $5,000 equals $1,200. So the $1,200 or $1,200 of additional tax that Albert and Shirley must pay when they file their taxes means the total cost of their charitable gift is $5,000 plus that $1,200, or a total of $6,200. Remember, the gift did not impact their standard deduction. The RMD behind the gift just added to their income. Ouch. Now let's see what happens if Albert and Shirley used the qualified charitable distribution to give the $5,000 to charity. Instead of requesting a $5,000 distribution from his IRA to go into his bank account, Albert would simply have his IRA custodian transfer the $5,000 RMD directly from his IRA to the charity. That satisfies Albert's yearly RMD because he is over age 73. Now the charity is in the same position as before. They receive a $5,000 donation. A good day. Albert and Shirley, however, are in a better position. They still give $5,000 to charity. Even though they receive no deduction for making a contribution, their IRA distribution is excluded from their tax return. Therefore, they owe no income tax on the $5,000 distribution. Their total cost to give the $5,000 to charity is $5,000. This is a $1,200 savings over our previous example, simply by knowing how to use the tax rules to their advantage. And they did it all without ever getting a deduction. Well, we all know charity starts at home, right? So it's a natural question to ask, how does retirement tax planning figure in? And it's a very good question because the government still wants its share of those tax deferred assets when you pass away. And like we've seen, how much you set things up really matters, which leads us to our final key number. Organize your assets for your family's benefit. Estate planning still matters. And what we're going to focus on here is how to preserve your assets by talking about long-term care. Now, this is not a long-term care presentation. It's about retirement and taxes. But believe it or not, there are a number of tax breaks associated with long-term care insurance. For example, long-term care premiums may be a deductible medical expense at the federal level and possibly eligible for deductions or credits at the state tax level. And on the other side, if you are receiving long-term care benefits, in many cases, those benefits are tax-free. For instance, benefits received from reimbursement style policies are tax-free. In addition, cash benefit style policies are tax-free if they don't exceed the higher of your actual long-term care costs or an IRS daily limit, which is currently $390. Choosing how you pay for long-term care costs can have a big impact on your estate and your heirs. In recent years, non-traditional long-term care policies that blend together some long-term care insurance and life insurance have become popular. Often, the first inclination of the insured here is to tap the policy to pay for long term care costs. But that's often a tax mistake. Let's take a look at Florence, a widowed woman who qualifies for long term care benefits and lives at home with in home care. Her yearly care costs are $60,000. Florence's Social Security benefit is $20,000 annually, which covers her basic expenses, but not long term care. She also has $400,000 in an IRA and a life insurance policy with a long term care rider that will pay $500,000 to Florence's children upon her death. Alternatively, Florence could use up to $10,000 per month for long term care costs. Any amounts used for long term care will reduce the life insurance death benefit. Now, please note this is just an example. This is not meant to represent any specific policy, but many long term slash life insurance hybrid policies work this way. First, suppose Florence is infirmed for 5 years and uses her policy to pay for long term care expenses. That's why she bought it, right? Here, Florence pays little to no income tax during this period because she'll have such large unreimbursed medical expense deductions. The $500,000 policy pays out $300,000, $60,000 per year for 5 years. That means her kids will inherit tax free life insurance of $200,000, the remainder of the $500,000 policy value. In addition, her children will receive the $400,000 in her IRA, which will be, of course, taxable to them. Now, let's suppose Florence lives for the same 5 years, but uses her IRA money to pay for the long term care expenses instead. Florence still pays minimal income tax per year because of her high medical expense deduction. And now the kids will inherit the $500,000 of life insurance completely tax free, as well as roughly a $100,000 of remaining IRA money, which will be taxable. Comparing the scenarios, the ultimate net benefit is unknown because it depends on Florence's children's tax rates. But it's hard to imagine a scenario where paying for her care with $300,000 of taxable money with minimal cost to Florence is not a better option than paying for her care with $300,000 of tax free money. In the second scenario, we're preserving the tax free money for the heirs and paying for the long term care with Florence's taxable IRA money. All right, so we are towards the end today, and you're probably thinking, goodness, how in the world will we ever manage this? And that's a very good question. So let's bring this all together. We started with a clear statement about the problem. Retirees often pay more taxes than expected because a confusing system treats various income types differently and contains hidden taxes and penalties. So let's do a quick review on what we've learned in the context of the 4 stages of retirement. Under the pre retirement heading, we saw the importance of understanding the after tax value of your retirement savings before you retire. We also saw that in those pre retirement years, it's critical to consider your tax deferred savings and start taking advantage of funding Roth accounts to fill your brackets, something you do through your early retirement years in low tax years. We also looked at Social Security and taxes, plus the importance of couples have benefit strategies that consider the surviving spouse. And we saw Medicare has its own tax like structure that can push you off the IRMA cliff. And we saw the importance of signing up for Medicare on time, right in the middle of those early go go years. That's because starting in your middle retirement years, you'll be confronted with required distributions. And we've seen the importance of planning your income needs before then and the tax issues involved. And then we saw the importance of setting up your assets and managing them during the later years of retirement so that you can preserve the most for your heirs and leave them with the most tax flexibility. All those items together lead us to this obvious solution to our original problem. Because your tax exposure will change throughout retirement, You need a strategy that anticipates how and when you tap assets to cover your personal expenses, that understands the range of taxes you will face at various stages, and that manages your actions so you pay the lowest tax rate possible. By attending today's presentation, you are indicating that you're preparing to leave the accumulation phase, which is saving for retirement, and move into the distribution phase when you start spending your retirement assets. We've seen that the distribution phase is more complicated than working and collecting a paycheck. Managing your tax rate through the 4 stages of retirement is part of the challenge of retirement planning. We've seen the cost of mistakes. Now, naturally, we want to be efficient with our savings, and there are strategies to reduce your tax burden. But as with many things in life, this takes education and planning and advice. Quite frankly, it is a lot to think about. Our tax code is complex, and the rules keep changing. But what doesn't change is that you need a plan. Now, I've used a process for many years to help people get from where they are now to where they want to be. If you are an existing client attending this message, you know about this process. I call this process our CCC or 3C process. First step is to clarify, understand your current situation. Second step, consult, talk about it, discuss it, understand it, make sure everybody's on the same page. And then lastly, if a better path forward presents itself, then we put necessary steps into action and we capitalize on that plan. Now, during this process, we will incorporate a retirement tax planning strategy, right? There's a lot of components that go into this process. So from a tax planning standpoint, we identify where you and your family stand in regard to preparing for retirement, reviewing your timeline, and identify key retirement planning and tax issues that you need to anticipate. Coming out of this process, we can act as your resource and help you find the right people to assist you in specific tax advice if you need it. Naturally, we can help you with the key financial planning and investment advice that relates to your situation as well. We want you to be prepared and organized for this aspect of your life so that you and your family can have peace of mind knowing that you've got a plan for making the most of your retirement accounts. So if you'd like to schedule this process, you can do so right at our website. It's investwithccg.com. And if you do so today, well, then I will get you a copy of the summary of today's presentation that I showed you at the beginning, again, titled the same as the presentation itself, How Tax Planning Changes Through 4 Stages of Retirement. We've got all 4 keys in here, important bullet points and everything. So if you schedule today, I'll make sure that I have a copy of this summary for you. And we'll also have a more comprehensive guide. You can kind of see it on the video here. This more comprehensive open guide here called The Guide to Taxes and Your Retirement. And so I'll have both of those resources for you if you take the time to get on the calendar here today. All right, that brings us to the end of today's message. So thank you for your time. Thank you for your education, for your attention. I hope that this has been educational for you. Again, we just want to provide education so that you can be informed about those important aspects as you think about your personal financial future. So again, head on over to the website, and sincerely, I hope to see you on the calendar very, very soon. Bye, everybody.